You are about to see the exact setup that I used to get funded $1.7 million in 4 months. Now, I won't lie to you and say that it's the most profitable setup out there because very likely it's not. However, it is one that I backtested for over 100 trades, proving that it works even before I started trading it on prop firms. And the very first step is we are going to find our bias. Now, what exactly is our bias? Our bias is the direction that price is very likely going to continue moving towards. Price moves in trends, so that means that if it's trending higher, it is likely going to continue moving higher. Likewise, if it is going down, it is also going to continue searching for lower prices. So of course, how do we do this? Well, we want to look on the left side of the chart. And this is something that you don't want to complicate. So if price is moving in a trend and there's higher highs and higher lows, then of course, we're going to automatically assume that it is going to be bullish. Now, every once in a while, you'll actually see a chart that literally looks something like this, almost like it's trading sideways. You can still find a trade here. And the easiest way to do this is to look for the most recent extreme. So in this case, we have a high up here, and also we have a low down there. For the most recent extreme, so in this case, it's going to be that low, we are going to look for the high, which led to the lowest low. And this high all the way up here is what we're going to be calling our break of structure level. Now, what exactly is a break of structure? Very simply, a break of structure is when the trend actually changes. And as long as that break of structure level is being defended, we are going to continue believing that price is bearish. Why? Because the most recent trend extreme was a low, and price up from this point is forming lower lows, lower highs, lower lows, lower highs, and then lower lows. We want to think of our break of structure level as the line in the sand that price is going to defend, because if bears want price to continue going lower, then they're going to want to defend that line in the sand. Now, we're going to be going back to our bullish example, and same thing. We ask ourselves, what is the most recent extreme? It is this high all the way up here. So then we take this low, again, it's the low that led to the highest high, and we call this our break of structure level. This is again the place that we want to see buyers defend if they want to see price continue going higher. Once we mark out our break of structure level, if price goes below the break of structure level, we don't automatically assume that price is now going to be bearish. Why? Because a lot of the times, price ends up bouncing out, sweeping those lows and then continuing into higher highs. So how do we know if price is still bullish or bearish on a time frame? Well, we have to wait for a close. If this candle down here closes below the break of structure level, then that means that price is now bearish. So one thing that we want to keep in mind is that this setup is going to maximize probability of working out. So therefore, we are going to be trading with trend. So an example is looking at this 5-minute chart on ES. We can see that there is a recent high all the way up here. From there, we can assume that price is now bullish. Why? Because we can tell that price is trending higher with higher highs and then higher lows, higher highs, higher lows, higher highs, higher lows. Once we assess our bias, we're going to mark out the break of structure level. So it is going to be this low right here. Why? It's because it's the low that led to the highest high. Now this becomes our line in the sand. So if you want to take trades on the 5-minute, we're going to look for trades that continue moving higher. Now, if we play out the rest of the charts, we can see that a new high forms. So what happens to our break of structure level? Well, it moves up because this now becomes, this right here becomes the low, which led to the highest high. We're going to continue assuming that price is moving higher. Now, as we can see, there is a 5-minute close below the break of structure level. So what does this mean? It means that our bias has now changed. We are now bearish, so we are now going to look for trades in the opposite direction. In this case, it's to the downside. At the same time, we're of course going to mark out the high, which led to the lowest low, which is this right here. So this is essentially how we find our bias, and it's the direction that we're going to be taking trades in. Oh, and one thing that I did want to clarify is that in step 1, when we find our bias, this is going to be, or this is what I use, I do this on the 1-hour time frame. So that means that whatever bias the 1 hour is in, that's what I'm going to be finding trades in. So if the 1 hour is bullish, I'm going to be looking for longs. If the 1 hour is bearish, I'm going to be looking for shorts. Now, the second step is we're going to go over to our 15-minute and then look for the bias. And the reason why we do this is because it acts as the second gate to confirm our direction. So that means that if the 1 hour bias up here is bullish, but our 15-minute is bearish, it means that we do not take a trade. You find the 15-minute bias the same way that you do the 1 hour. And step 2.5, we kind of already briefly went over this, but you want to mark out your break of structure levels on the actual chart. Next, for step 3, we're going to mark out our high time frame confluences, What are our high time frame confluences? It is going to be liquidity and fair value gaps. Now, our high time frame is the 1 hour and the 15 minute. So we're going to go to the 1 hour and then look for any liquidity or fair value gaps, and same thing for our 15 minute. And very briefly, what is liquidity? Well, liquidity is passive orders that allow for institutions to actually enter. We all know that the people who actually move the markets are institutions, and institutions have big size. So what do they need? They need opposite orders. So what are opposite orders? It means that if they know there are buy orders above highs, that's how they're going to enter short. So for example, we take this case right here. Where is liquidity? Liquidity is above highs or swing highs when we are bearish. Now, if price were to come back here and retest this exact area over here, more often than not, retail traders have buy orders sitting above this high. Now, why are there buy orders there? It's because that is where retail traders have their stop loss. Therefore, if we know that there are buy orders over here, who are the ones who are making money and are actually wanting to push the market down? It's going to be the institutions who are now entering their short positions when price sweeps that exact high. Another thing that I wanted to add on to is that the reason why there are more buy orders over here is because people anticipate that when price breaks above this high, it's going to be a breakout into new highs. So that's why they actually enter long. So it's that combination of you have stop losses and then you have breakout traders who expect price to reverse. And those are the orders that institutions actually fill on. So what exactly is a fair value gap? Well, a fair value gap is unfilled orders due to an aggressive movement. So if price retests and bounces, we assume that price will continue moving in the direction of the trend. And don't worry, I am explaining all this conceptually, but once I finish, I'll go onto the charts and actually show you what that looks like. If we look at this specific leg right here as a part of this bullish trend up, we can see what they look like in their candlestick form. If we are bullish and we're looking for a bullish fair value gap to enter long on, we are going to mark out this box right here. Now, how do we actually define this box? Well, it is the high of the first candlestick. So we're going to label these 1, 2, and 3. And it's the low of candlestick number 3. And that is what creates this box that we can see right here. Now, long story short, price moved up so aggressively in candlestick number 2 that if price were to continue moving over here, we are going to assume that there are traders who weren't able to get filled. So therefore, if they see price revisit this price area, they're going to want to enter to be a part of the move up. And the same thing for a bearish leg down, we have candlesticks 1, 2, and 3. As we can see, the low of candlestick number 1 is going to be the high of this fair value gap, and the high of candlestick number 3 is going to be the low of this fair value gap. So therefore, if price were to revisit over here, we're going to assume that there were a lot of short entries that are waiting to be filled. So if price moves down, we're going to assume that price is going to continue moving down. So these are our high time frame confluences that we're going to be marking out on the charts, and I'll go ahead and give a demonstration of what that looks like right now. So going back to the same chart that we saw earlier, first off, this low down here used to be the break of structure level when price was previously bullish, but because price closed below that break of structure level, we are now bearish. So our break of structure is now going to be sitting at this high up here. And you'll notice that a break of structure level is a swing high. And swing highs are what we mark out for liquidity. Alongside this, you can see this huge candlestick right here and this huge gap in between the low of candlestick number 1 and the high of candlestick number 3. So what we're going to do is we're going to actually mark out this box right here as a fair value gap. So think of this whole process of finding the bias, marking out high time frame confluences. This is the same exact steps that we're going to be doing on the 1 hour. I'm just showing it to you on the 5 minute just for example's sake. And then we can see a move up, then a move down. So that is going to be a swing high. We're going to mark out the high, and that is going to be our high time frame liquidity. Why? It's because when price is bearish, we're going to be marking out these swing highs. If price were bullish, so back here, we're going to be marking out these swing lows. And now step 4 is we wait. We're going to be waiting for a high time frame confluence to be activated. So what does this mean? It means that we're waiting for our liquidity to be swept, or we're waiting for a fair value gap to get filled. So going back to the charts, every time price forms a green and then a red candle, we are marking out the swing highs. And we can notice that right here is a swing high which forms. And on the very next candle at 8:15, the high was actually swept. Price moved above that high, and we can assume that there were some orders that were filled. And the other instance is when a fair value gap ends up forming and price retests it. So in this case, it would look something like this. Let's pretend that that red candle never happened, but instead price formed this big green candle. As we can see, price actually entered this fair value gap, which is when the confluence is activated. And now for step number 5, we are going to switch to the lower time frame. So again, what was our higher time frame? Our higher time frame was the 15-minute as well as the 1 hour. And our lower time frame is purely just the 1 minute. So for step number 6, we're just going to be looking for a break of structure on the 1 minute. So let's assume that this chart right here is the 1 hour. We marked out this high, which is liquidity, and if price swept this high up here, let's go ahead and zoom down to the 1 minute and see what that looks like. If we were to swap into the 1 minute, we would see that price is very likely in a bull trend. This section right here is a trend higher. That is how price swept high time frame liquidity. Now going back to our break of structure levels, again, break of structure levels can apply to any time frame. So we're going to look for the low, which in this case is right here, that led to the highest high. We are going to label that low as the break of structure level. So at this point in time, we are going to be waiting for price to eventually break structure to the downside. This is essential because again, we are trading with trend on the 1 hour. So if there is a reversal at this high time frame confluence, we would see it first on the 1 minute. And that is how we are going to get bigger reward to risk ratios because we are capitalizing on a higher time frame move and entering on the lower time frame. And because the example that I used on the chart was the 5 minute as the higher time frame, I'm going to go ahead and actually show a proper chart with the actual right time frames. But for now, we're just going to continue going on to step 7. In step number 7, we are going to wait for displacement before you actually enter. So right before we enter, we are waiting for 2 things. It is going to be, again, step 6, waiting for that break of structure. And also, we are waiting for displacement. And displacement is literally just evidence of large institutions actually entering. So what exactly is displacement? Well, displacement is when it meets at least 3 out of the 4 criteria. Criteria 1 is the candles are expanding in size. Number 2, they have strong with trend closes. Number 3, there are large bodies and small wicks. And number 4, there is little overlap. And as a quick demonstration for each of these candles expanding in size, it means that if there was a break of structure at this candle right here, we want to see that it is bigger in size compared to its previous candles. A demonstration of the second criteria is that there's a strong with trend close. Strong with trend close just means that it closes near its high if we're bullish, or it closes near its low if we're bearish. In this candlestick right here, this is not a good example because price closes basically below the midpoint of this actual candlestick, hence it having a bigger wick. And that kind of ties in with this criteria down here, or the third criteria, which is large bodies and small wicks. This candlestick right here is an example of a large body and small wicks, meaning that throughout the actual duration of the candlestick, price was pretty much just expanding higher. Versus this candlestick right here, which has a smaller body and larger wicks, which goes to show that price was trending over here for a little bit, it might have reversed, and then ultimately it failed to really continue expanding in the direction of the trend. And lastly, for little overlap, as we can see these 3 candlesticks right here, there's basically no overlap between this candle, and this candle. It basically is just a large move higher. However, in these series of candles down here, we can see a lot of them, it basically is just staying stuck in this little range, and there's lots of overlap, which just goes to show that price doesn't really have a lot of direction. So as long as displacement meets 3 out of these 4, then I would consider it valid. After that, step number 8 is simply just to enter once you observe the break of structure and displacement. For our stop loss, we're going to be using either 5 points or 10 points, and this is all based on the previous candles and their ranges. So as a quick example, if the most recent candles had a range of about 4.25, then the next candle is 3.75, and then the next was 6, then we are going to use a stop loss of 5 points. And same thing, if the most recent candlesticks had a range of like 9.5 and then maybe 8.25, right? And then the next candlestick, the actual break of structure might have happened at 12 points, or that candlestick might have had a range of 12 points, then we're going to use a stop loss of 10 points. So pretty simple, literally only 2 different stop loss options. And when I say 5 points or 10 points, I mean that is what we are going to be taking from the entry. Lastly, our profit target right here is going to be 2R. So that means if our stop loss is 5 points, our profit target is 10 points. If our stop loss is 10 points, our profit target is going to be around 20 points. So for a quick example, if we are long and our entry is at 7,000.5, we're going to look at the previous candlesticks. So let's say that the average range for the candlesticks is about 5 points. Then we're going to have a stop loss of 6,995.5. And our profit target is just twice our stop loss. So in this case, it would be 7,010.5. And lastly, for step 9, we are going to be waiting for our profit target or stop loss to be hit. let's go ahead and transfer over into the chart so I can show you what that actually looks like from the start to finish. So heading onto the charts, we're going to start off on the 1 hour. As we can see right here, this is the most recent trend extreme, which is this high. So we're going to assume that price is bullish. And to confirm that, we're going to look for higher highs and then higher lows, higher highs, higher lows, higher highs. So we now know that price is officially bullish, so we're looking for longs. Same thing on the 15-minute. After swapping down, we can see that the most recent trend extreme was this high up here, and we can confirm that price has been moving with higher highs, higher lows, so therefore the 15-minute is also bullish. After that, we are going to be marking any forms of high time frame liquidity. So in this case, it can be this 15-minute low right here, or it can also be this 15-minute fair value gap over here as well. And as price continues to actually continue forming throughout the day, then we can go ahead and keep updating new liquidity and new fair value gaps. So let's go ahead and see what happens every 15 minutes. So for this specific trade example, I'm going to be hopping onto the 1-minute chart, and we're going to wait for price to either enter this 15-minute fair value gap or for price to sweep this 15-minute liquidity. As we can see on the exact candle that price opened, price sweeps liquidity, and now we're going to be waiting for a 1-minute break of structure along with displacement. Now, what is a break of structure on the 1 minute is going to be the high, which led to the lowest low. So in this case, we're going to mark it as this right here, this level right here. Why? Because when price opened up, it might have formed this high up here, and then it went all the way down, and then it actually reversed. So just having something that we know where sellers are likely going to defend, that is the break of structure level. After time skipping a few more candles, we can see that on this next candle, price actually does form a 1-minute break of structure because it closes above this high. However, look at these candlesticks. They're overlapping. We got large tails, smaller bodies. It's not really the one that we want to fully enter on. So we're going to continue waiting. And on the very next candle, look at this candlestick right here. It has a range of about 5. The previous candle had a range of about 3.5. Last candle, range of 4.75. So as you can see, the range looks to be expanding. And this candle is a lot stronger in trend compared to the other candles. Why? Look how large the body is. It's huge compared to the tail, and it has a really strong candle close. And then we're going to place our stop loss 5 points below our entry. So if this candle had a close of 52.25, we're going to place our stop loss somewhere around 47.25, somewhere in this area. And in order to make that even easier to see, I'm going to label this red, and then I'm going to label this entry up here as blue. So now we have our profit target and our stop loss. So let's watch and see what is going to happen. So price ends up ripping higher, but before we see that, we are going to actually, let's pretend that we placed our stop loss and our profit target. And also these profit targets aren't exact. It's just to show you or give an example of what it might look like. And as you can see, price ends up ripping and hitting the profit target being 2 times our actual risk. So I'm actually going to adjust it so that it's a bit more precise, but this candlestick right here has a close of 52.25, so that is correct regarding our entry. However, our stop loss is at, or should be at, 47.25, making our profit target closer to 62.25, which price actually does still end up hitting. And I'm also going to be showing you another trade example. So for this case, we can look at our most recent trend extreme, which is this low all the way down here. So we're going to assume that price is probably bearish, and we're going to confirm that by looking at lower highs, lower lows, lower highs, lower lows. So we can confirm that the 1 hour is bearish. On the 15-minute, we have the same exact occurrence happen over here. We see this trend extreme down here, so we assume that price is bearish, and then we also look for lower highs, lower lows, lower highs, lower lows. So 15-minute and 1 hour are officially both bearish, so we can continue marking out any high time frame confluences in order to look for a setup. And I actually did form a little bit of a sneak peek, so you weren't supposed to see that. But if you were marking out the chart during pre-market, you would see that this swing high, so this green and then a red candle, has a high of 67.25, which is what we mark out as 15-minute liquidity. After that, on the 1-minute chart, we can see that price actually sweeps the 15-minute high right at around 639. So the 1-minute bias is probably bullish. So we are going to mark out the break of structure level, which is at this low down here. How do we know that? It's because this low right here led to the highest high. So therefore, if price were to break and close below this 1-minute break of structure level, we can assume that price is going to continue trending lower because price is bearish on the 1 hour as well as the 15-minute chart. So now we're going to wait for a 1-minute break of structure to the downside, which happens right here. So now we're going to assess displacement. Look at how this candlestick is expanding and it has a higher or bigger range than the previous candlestick. Alongside this, these 3 candlesticks all close near their lows and they have small tails and large bodies. So this pretty much already meets the criteria for displacement. So what are we going to do? After seeing this candlestick form and close, we are going to be entering at the close. So that is at 68.48. And let's look at the range here. 8.75, 4.25. Range is about 9. Other candles about 10.5. So in this case, we are a little bit in a dilemma. So you can either use a stop loss of about 5 points or you can use 10 points. In this case, just to be safe, I'm going to use a stop loss of about 10 points. So the actual entry is at 68.48. So the actual stop loss is going to be at 68.58. So price continues moving a little bit lower and then ends up hitting our stop loss right here. So I wanted to show you a form of a loss because I don't want to ingrain this mindset that every single trade you take is going to be a winner. I want it to be as transparent as possible. And I just wanted to give you the reality that half of the trades you take are going to be winners, but the other half are going to be losers. However, this strategy still works because the average win is 2R compared to 1R. So you're going to be making more than you lose. Hence, that's how you actually come out with a profitable strategy. So that was a more basic overview of what my strategy looked like. If I actually go into the exact specific technicals of why I do something, the video might end up taking a lot longer, probably closer to like a few hours. So if that seems interesting to you, then let me know in the comments. However, for now, I hope that I just provided you some form of idea for how you can actually implement a strategy like this to your own setup. But the most important thing that I'm going to recommend is that you actually backtest it, find the rules that meet your specific strategy and your specific criteria and meet your actual personality. And by doing that, that is how you're actually going to be replicating it over the long term, hence allowing you to accumulate a lot of funding and eventually a lot of payouts. And if you trade prop firms and you recently came from a losing streak and you blew your account, I would like you to walk me through the last time that you either revenge traded or you took a trade that you weren't supposed to. I'll help you break down where exactly things went wrong so that you can prevent that same mistake from happening again. So if that seems interesting to you, click the link in the description and let's talk.